Index investing is a passive investment strategy that involves buying a portfolio of securities designed to track the performance of a specific market index. A market index, such as the S&P 500 or Nasdaq, represents a specific segment of the financial market through a collection of securities. Unlike active investing, where managers try to outperform the market through stock selection and market timing, index investing aims to match market returns by holding all or a representative sample of the securities in the target index. Index funds provide investors with broad market exposure, allowing them to participate in market growth over time while minimizing costs. Index funds work by holding securities in the same proportions as the target index and automatically adjust their holdings when the index changes. Popular market indices track different segments of financial markets, each offering unique exposure characteristics. The S&P 500 tracks 500 largest U.S. companies by market cap, broad U.S. large-cap equity exposure. The Dow Jones Industrial Average tracks 30 prominent U.S. blue-chip companies, blue-chip U.S. company exposure. The Nasdaq Composite tracks technology-heavy index of 3,000-plus companies, technology and growth stock exposure. The Russell 2000 measures performance of 2,000 small-cap U.S. stocks, small-cap U.S. equity exposure. The MSCI EAFE tracks international developed markets outside US and Canada, developed international market exposure. The MSCI Emerging Markets tracks equity market performance in global emerging markets. Emerging market growth exposure. The Bloomberg Barclays U.S. Aggregate Bond tracks the U.S. investment-grade bond market, broad U.S. fixed income exposure. Each index represents a different segment of financial markets, providing varied risk-return profiles and diversification benefits. Index funds use different approaches to track their benchmarks. Let's explore the four main construction methods. There are four primary methods used by index funds to replicate their target index's performance. First, let's examine full replication. This is the most straightforward approach. In full replication, the fund holds all securities in the index in exactly the same proportions as the index. This approach provides precise tracking and full exposure to all securities, but can incur higher transaction costs, especially with large indices containing hundreds or thousands of securities. As shown in this performance graph, full replication typically achieves the closest tracking to the index benchmark. The second method is sampling, also known as stratified sampling or partial replication. Sampling holds a carefully selected subset of securities that collectively mirror the characteristics of the entire index. This approach reduces costs while maintaining representative exposure. However, it introduces some tracking error and requires sophisticated statistical techniques to ensure the sample accurately represents the index. Sampling typically introduces a small tracking error compared to the benchmark, as seen in this performance comparison. The third method is optimization, which uses advanced quantitative models. Optimization employs mathematical models to select securities that match key risk and return characteristics of the index, while minimizing costs and operational challenges. This approach effectively balances tracking accuracy with cost efficiency, but introduces complexity and potential model risk, and may be less transparent to investors. Optimization typically produces tracking results similar to sampling, but with potentially lower costs in certain market conditions. The fourth method is synthetic replication, which uses derivatives instead of directly purchasing securities. Synthetic replication uses derivatives like futures, options, or swap contracts to gain exposure to the index without directly owning all the underlying securities. This approach can offer cost efficiencies and easier implementation, particularly for hard-to-access markets, but introduces counterparty risk and regulatory considerations. Synthetic replication can achieve very precise tracking in normal market conditions, but may experience disruptions during periods of market stress. Let's now compare these four methods across key characteristics like tracking accuracy, cost, and complexity. The choice of construction method depends on multiple factors, including the complexity and size of the target index, market conditions, fund size, and investor preferences. While index funds are generally low-cost investment options, understanding their fee structure is crucial for maximizing your returns. Let's examine the different types of costs associated with index investing. The most common cost is the expense ratio. This is the annual fee charged by fund companies to manage the index fund. Expense ratios for major index funds typically range from 0.03% to 0.25%. This is significantly lower than actively managed funds, which can charge 0.75% or more. Let's compare expense ratios across different funds tracking the same index. As you can see, even among S&P 500 index funds, fees can vary significantly. Even a seemingly small difference of 0.12% in expense ratios can significantly impact your returns over time. When you buy or sell ETFs, you may encounter trading costs in the form of bid-ask spreads. The bid-ask spread is the difference between the price at which you can sell the ETF, the bid, and the price at which you can buy it, the ask. For example, if the bid price is 1 or 2.25 cents and the ask price is 1 or 2.75, the spread is 0.50 cents or about 0.49% of the share price. ETFs tracking major indices typically have very narrow spreads, often between 0.01% and 0.1%. However, less liquid ETFs may have wider spreads, which can significantly increase your trading costs. Tracking error measures how closely an index fund follows its benchmark index. Let's visualize how an index fund might perform compared to its benchmark index over time. The gold line represents the index performance, while the blue line shows the fund. Notice how the fund slightly underperforms the index over time. This difference, known as tracking error, is typically around 0.20% for well-managed funds. It's caused by expense ratios, cash holdings, sampling methods, and rebalancing practices. Now, let's see how even small differences in fees can significantly impact your investment returns over the long term. This chart shows the growth of a $10,000 investment over 30 years with an 8% annual return, but with different expense ratios. As you can see, with a low expense ratio of 0.03%, your investment grows to nearly $100,000. With a moderate fee of 0.25%, it reaches about $86,000. But with a higher fee of 0.75%, you end up with only $64,000. That's a difference of nearly $35,000, or 35% of your potential returns, just from differences in fees. This clearly demonstrates why investors should pay close attention to expenses when selecting index funds. Beyond fees, investors should also consider tax implications. ETFs are typically more tax efficient than mutual funds. Index funds with lower turnover generate fewer capital gains distributions, and tax-managed index funds are specifically designed to minimize tax impact. Index investing versus active management is a long-standing debate in the investment world. Let's examine the performance aspect first. Historical data shows that indices outperform approximately 80% of active managers over 15-year periods. This graph shows the growth of $100 invested in an index fund versus various active managers over a 15-year period. The index fund follows a steady upward trajectory based on market returns. Active managers show more volatility, with most underperforming the index over the long term. When we look at the distribution of returns, we can see that about 80% of active managers underperform their benchmark indices over 15 years. Let's examine risk management, another key factor in the debate. Active managers may be able to reduce downside risk during market corrections or bear markets. During market declines, skilled active managers can shift to defensive positions, potentially minimizing losses compared to index funds. Market efficiency is another important consideration in the index versus active debate. Active strategies tend to be more effective in less efficient markets, such as small-cap stocks or emerging markets. In highly efficient markets like large-cap U.S. stocks, information is widely available and prices quickly reflect all known information, making it difficult for active managers to outperform. Finally, your specific investment goals might determine whether an index or active approach is more suitable. Some investment objectives may require active management approaches to achieve specific outcomes beyond market returns. This table shows which approach might be better suited to different investment goals. In summary, the choice between index and active management depends on market conditions, your specific investment goals, and personal preferences. Building a portfolio with index funds requires careful planning of your asset allocation. Asset allocation begins with determining your risk tolerance and time horizon. Conservative investors typically have more bonds and less stocks, while aggressive investors allocate more to stocks for potentially higher returns. Geographic diversification is another important aspect of portfolio construction, spreading investments across U.S., international developed, and emerging markets. A common allocation might be 60% to U.S. markets, 25% to international developed markets, and 15% to emerging markets. Balancing equity and fixed income exposure is crucial. Stocks offer higher potential returns, but with higher volatility, while bonds provide stability but lower returns. A portfolio combining both can create an optimal risk-return profile along the efficient frontier. A popular approach for index investors is the three-fund portfolio, consisting of a total U.S. market fund, a total international fund, and a total bond market fund. This simple yet effective strategy provides broad diversification across asset classes and geographic regions. Your allocation between these three funds will depend on your risk tolerance, with more conservative investors holding more bonds and aggressive investors focusing more on stocks. Buy and hold is a passive strategy where investors purchase index funds and hold them for the long term, regardless of market fluctuations. This approach minimizes trading costs and capitalizes on the market's long-term upward trend. Dollar cost averaging involves investing a fixed amount at regular intervals, regardless of market conditions. This disciplined approach helps investors buy more shares when prices are low and fewer when prices are high, potentially reducing the impact of market volatility and emotional decision-making. The core satellite strategy combines passive and active investing approaches. The core portfolio consists of broadly diversified index funds representing 70 to 80% of assets. Around this core, investors add satellite positions in specific sectors, styles, or markets where they believe active management or specialized focus can add value. Factor investing targets specific characteristics of securities that have historically delivered superior risk-adjusted returns. Common factors include value, momentum, quality, size, and volatility. Specialized index funds allow investors to tilt their portfolios toward these factors to potentially enhance returns or reduce risk. Tactical asset allocation involves making short to medium-term adjustments to your portfolio's asset mix based on market outlook. Unlike static index portfolios, this strategy shifts allocations between different index funds representing various asset classes. When bearish conditions are expected, exposure to defensive assets increases. During bullish outlooks, allocations shift toward growth-oriented indices. Let's compare these 5 common index investing strategies. Buy and hold and dollar cost averaging are simple approaches ideal for beginners. Core satellite and factor investing offer more sophistication for those seeking enhanced returns. Tactical asset allocation requires the most active management and market monitoring. Many investors combine multiple strategies to create a personalized approach aligned with their financial goals and market views. Getting started with index investing involves 5 key steps. First, open an account with a low-cost brokerage. Next, determine your investment goals and risk tolerance. Then, select appropriate index funds aligned with your strategy. Set up automatic contributions to maintain consistency. Finally, establish a regular rebalancing schedule. Step 1 is to open an account with a brokerage that offers low-cost index funds. Several major brokerages offer excellent index fund options. Vanguard, Fidelity, Charles Schwab, and Robinhood are popular choices. When selecting a brokerage, consider trading fees, account minimums, customer service quality, and the user interface. Step 2 is to determine your investment goals and risk tolerance. Your investment timeframe is a critical factor. Short-term goals require more conservative allocations, while long-term investments can focus on growth. Your risk tolerance falls on a spectrum from conservative to aggressive. This determines your mix of stocks and bonds. Steps 3 and 4 involve selecting appropriate index funds and automating your contributions. Begin with these core index fund types. Total market funds provide broad exposure, while S&P 500 funds focus on large U.S. companies. International funds offer global diversification, and bond index funds provide stability. Automating your investments is crucial for long-term success. Set up recurring transfers from your bank account, choose between dollar-cost averaging or lump sum investing, select a contribution frequency, and reinvest all dividends automatically. The final step is to establish a regular rebalancing schedule to maintain your target allocation. Start with your target allocation, such as a classic 60% stocks and 40% bonds portfolio. Over time, market performance causes your allocation to drift. If stocks outperform bonds, your portfolio might shift to 75% stocks and 25% bonds. Rebalancing brings your portfolio back to your target allocation by selling some of the outperforming assets and buying more of the underperforming ones. You can rebalance on a calendar schedule, such as quarterly or annually, or use a threshold-based approach when your allocation drifts by a certain percentage. Consider tax implications by rebalancing in tax-advantaged accounts first. Let's visualize the power of index investing over time with a growth projection. This chart shows two scenarios based on a $10,000 initial investment with $500 monthly contributions. The conservative portfolio grows at 6% annually, which is typical for a balanced index portfolio. An aggressive portfolio with a higher allocation to stock index funds might achieve 10% annual returns over the long term, resulting in significantly more growth. This demonstrates why starting early and staying consistent are crucial for successful index investing. As you get started with index investing, remember these key takeaways. Begin with low-cost, broad market index funds. Focus on consistency rather than market timing. Automate your contributions to remove emotion from investing, and rebalance periodically to maintain your strategy.